welcome to this explainer. You know, for decades, institutional real estate was basically this giant walled garden. It was locked away behind massive capital requirements and super exclusive networks. Mostly, it was an asset class reserved just for ultra-high net worth individuals and massive conglomerates. But, well, the market dynamics are shifting rapidly right now. Today, we're breaking down how new tech and structural changes are totally democratizing these historically gated assets. We're going to look at how everyday investors can build sophisticated, yield-generating portfolios literally from the ground up. Let's dive in.
So here's the big question. Do you actually need millions in upfront capital to capture real estate yields today? It's a completely valid question. I mean, for years, astronomical property valuations paired with crazy interest rate environments made direct buying mathematically impossible for the average retail investor. The conventional wisdom was basically, hey, if you can't front 20% on a multi-million-dollar asset, you're boxed out. You're just totally locked out of the wealth-building potential of real estate. And man, that created an incredibly steep, frustrating barrier to entry.
Well, the short answer is not anymore. Seriously, no way. The current market is undergoing this fundamental structural revolution. You no longer need to buy an entire building, the whole bakery, so to speak, just to benefit from its economic output. By leveraging the power of fractionalization, getting the yield and appreciation of a high-value property requires only a fraction of that traditional massive bank account. The rules of engagement, they have fundamentally changed.
Think about the traditional model for a second. Buying a physical property means absorbing some intense operational drag. You're fronting heavy capital, you're dealing with constant tenant turnover, and you're the one handling emergency maintenance at 2 a.m. It's highly active sweat equity investing. But modern investing, it pivots away from that operational heavy lifting entirely. By purchasing equity shares instead of physical deeds, grabbing a hassle-free slice of the pie, you secure a passive stake. You're delegating all those day-to-day headaches to experienced professionals while drastically lowering your entry point.
This awesome pivot toward capital efficiency is largely driven by fractional ownership. Mechanically, this just means syndicating a property. You're buying, say, a 5 or 10% equity stake alongside a larger pool of other investors. And the true brilliance of this model is how it isolates your risk. You capture your proportional rental yields and asset appreciation, but you don't take on the sole burden of sudden liquidity squeezes or surprise maintenance bills. Specialized corporate entities manage the whole shebang for a transparent fee, leaving you to just focus on your portfolio allocation.
Then, of course, we have real estate investment trusts, or REITs. A REIT pools retail and institutional money to acquire massive institutional-grade portfolios. We're talking assets usually reserved for pension funds, commercial high-rises, huge industrial logistics hubs, sprawling healthcare facilities. But their true superpower, and why they are so vital to modern investing, is liquidity. Physical real estate is notoriously illiquid, right? It can take months or even years to clear a sale. REIT shares, on the other hand, trade daily on public stock exchanges. You can literally liquidate your position and access your capital in seconds.
And the historical data absolutely backs this up. On average, global REITs have historically distributed annual dividend yields hovering between 4 and 8%. 4 to 8%. In a macro environment where predictable, passive income is the ultimate goal, that provides a highly compelling yield spread over traditional fixed income assets, like government bonds. And the absolute best part? You get that predictable income without the physical management overhead that comes with direct property ownership.
Now, accessing these syndications and trusts has been aggressively supercharged by the digital revolution. Today, fintech platforms act as direct intermediaries, bringing institutional deal flow straight to your phone. The traditional gatekeepers are just gone. You can browse active syndications, carefully underwrite expected returns, and analyze localized market risk factors with just a few taps. By completely bypassing traditional broker networks, you significantly reduce the fee drag on your investments, meaning you keep way more of that yield in your own pocket.
Okay, but let's take a breath and shift gears for a second. As the old saying goes, if something looks too good to be true, it probably is. This unprecedented accessibility introduces new, modern friction points. Frictionless investing does not mean risk-free investing. Because the technological barrier to launching a digital investment platform is lower than ever, platform risk is a very real threat. Before you deploy a single dollar of capital, rigorous due diligence is completely non-negotiable. You absolutely must vet a sponsor's track record and ensure the platform operates under strict regulatory authorization, like SEC compliance.
Assuming the platform checks out, long-term capital preservation really comes down to fundamental diversification. To insulate your portfolio from localized market shocks, you need to systematically diversify across three distinct vectors. First up, geographic, spreading capital across different cities or regions to avoid regional downturns. Second, type, allocating capital across vastly different real estate sectors. And third, temporal, staggering your investments between ground-up developments that require some patience and stabilized, cash-flowing assets that yield immediately. Let's look a little closer at that type diversification vector. Different property sectors carry vastly different beta, which just means they react uniquely to broader economic shifts. For instance, think about a massive macro disruption, like the global transition to remote work. That's severely compressed valuations and occupancy rates in commercial office spaces. But if your portfolio is intelligently balanced across multifamily residential, industrial logistics, and maybe hospitality, the downside you experience in the commercial sector gets absorbed, or potentially even offset entirely by sustained stability in the others. It's really like a giant puzzle. But we absolutely need a reality check here. Fractionalization and modern fintech mitigate risk. They do not magically erase it. You are still fully exposed to core market forces. First is market risk, meaning underlying asset valuations will inevitably fluctuate. Second, liquidity risk remains notably high if you hold private syndications, since secondary markets for those shares are often practically non-existent. Third is regulatory risk. Zoning shifts or sudden tax code changes can crush your operational margins overnight. And finally, management risk. The sponsors and operators you trust to run the asset might simply underperform their projections. To successfully navigate this modern landscape, you've got to rely on a strict personal blueprint. Number one, define your financial capacity clearly. Never invest borrowed money or funds you need for daily expenses. 2, front-load your education. Understand the macro interest rate environment before committing any funds. 3, start small. Scale into positions slowly to test out platform mechanics and distributions. 4, religiously maintain that sector and geographic diversification at all times. And 5, lock in a long-term mindset. Real estate yields and appreciation compound best over a multi-year marathon. Ultimately, the most important question isn't how much money you have to play the game, but whether you have the discipline and the patience to actually play the long game. The modernization of real estate has totally stripped away the old excuses of the past. With fractional equity, highly liquid REITs, and seamless digital syndication, the traditional barriers have been completely digitized and dismantled. The institutional tools are right in your pocket. The only question left is, how strategically will you deploy them? Thanks for joining this explainer. Stay curious, and we'll see you next time.